I'm a visual guy. Let's go through and kind of visually observe each of these, okay? Number one, if price accepts into a balance area, we're likely to revert to the other side of balance, okay? So we push into the balance area. At that point in time, I expect us not to get above here in any meaningful way. It might wick into that area. You know, things are a little messier than perhaps we'd like them to be. And not trade through here and get to here as a destination for that move. Okay? Price inside a balance area is expected to reject the edges of balance until proven otherwise. And I tried to draw this one a little messier. See how we got kind of below the area and zipped back into it, a little bit above it, zipped back into it, and notice there's some choppier behavior. This time didn't quite make it to the edge. That's the nature of kind of a range-bound market very often. But the key is using these kind of laws, these dynamic study of the market, to set your expectations, to create your risk-reward at any point in time. This is what this is all about. Price action is choppier inside balance areas. I think most of us know that to be true. So really use that. Have that as a part of your plan. Have that as a part of your process as you're trading. Don't do a lot of stupid things inside of a fat balance area. Stop it, you know? We can all, it's one thing, anything we talk about in trading or whatever in life, it's one thing to admit it logically as a truth. It's another thing entirely to put that into practice in your life or in your trading. Very different things. We'll get Dr. S in here to teach us how to do that. If price accepts outside of balance, we're likely to become imbalanced, okay? So we expected rotational behavior, we're chopping around, and then boom, we get a meaningful move, meaningful volume, a weak retrace. We expect a trend to form, okay? We expect that to happen. Where's the risk reward? Well, reward may be older areas of balance above, a place where we can find a likely destination for that move. Where's the risk? Back inside. You know, what is the current market condition when we're in this condition? We're now imbalanced. We've accepted outside of a balance area. What is the current market condition? It's imbalanced to the upside. I know what strategies I want to begin to apply. I know where overall I'm wrong if we accept back into that balance area. What doesn't happen can be the most important information. Here's an example where this market is rotational, but it looks like we're actually holding this point of control, which can be a bullish factor, right? And we're continuing to kind of press against these high, and then we really kind of press and we think, okay, this is potentially a breakout of this composite, and all of a sudden selling pressure really starts to come in, and we pull back into the range. That was a breakout that attempted and failed, and that's very, very meaningful information. I would immediately switch to rule number one and expect the lower end of that balance area. In fact, a lot of times, a significant failure of the market to do one thing that it was clearly attempting to do leads to even better and even more movement the other way. In this case, in terms of trade management, one thing that I might do would be definitely heavy scales into this area, or at least have my finger on the trigger to really exit if buyers step in from the composite value low. But if we blow through it, you know, at little points in time, and we'll talk about this in the next course, you can structure brand new risk reward, so to speak, to where, you know what, if we start to bounce here at all, if we find buyer, this was my original target, this is all I was expecting. But you know what, I'm going to manually do this. If we start to bounce, sure, I'll get out. I'll make 5 cents less than I would have with a good limit order. So I'm going to risk 5 cents, but if this breaks down, I've got some serious reward. We're now getting imbalanced to the downside after a key failure on the upside. Oftentimes, the destination of an imbalance is a prior older balance area, and oftentimes, its actual point of control. You'll see this time and time again. We break out, we get imbalanced, we zip up to an older area of established value. Think of the Honda Accord example right here. All of a sudden the wheels are fixed, we zip back up to the recent 3-day balance. If price reacts strongly from a point of control, that can disrupt law number 1. This would be a law number 1 situation where we have accepted into this balance area. We got a weak retrace up into here. We are expecting to push all the way down to the lower end. We see a very strong reaction from the point of control. We can shift our strategy. We can take profits when we weren't expecting to perhaps take profits there. We can adjust when we see that. We've seen this in all the examples so far, but price often retests edges of balance areas to firm up the area, okay? And that can be both on this example that I have where we push in, we retest and go, and on the other examples like the trend examples where we push out, retest, and go. Even if I'm playing, even if I consider a trade like a short right here, a mean reversion type of trade, think about the implications of that. This may have been trending down to get to here, but I still consider it a mean reversion trade because we're actually reverting into the mean of this balance after attempting to break out of it. This would be a more of a trend type of play because we're leaving a balance, we're getting imbalanced. Time limits opportunities. We know this to be true. Markets, even though we live in this global, electronic trading era and whatnot of all this liquidity and round-the-clock trading, especially in the futures markets, we know that people still sleep and they're still humans, and the biggest financial markets are in New York and London and things like that. So there's time limitations on us. There are. Even if only because of habits, the way humans operate and have set to operate in these markets, they are forced to operate with each other, these big players, because they need liquidity. You can't just go to something at 1 a.m. and just fire off a giant order. What are you going to do? You're going to move that market. You got to play. These big players must play when the liquidity is there. So we do have time limitations on opportunities. Oftentimes, after a destination is achieved in a session, there's less opportunity going forward. So be aware of when you're structuring your plan for the day and you're looking at what might unfold and where the market might go, and it gets there, you may want to tone down your expectations for what the potential is for movement the rest of that day. This makes sense on a lot of levels. Maybe the market's even moved its average daily range already. And so kind of what do you really expect? Unless volume that day is through the roof and things are very, very active relative to normal, then you can continue pressing perhaps. But I still wouldn't be doing anything here. If I took this long as a breakout pullback type of trade to go with this imbalance, I wouldn't do anything in here. Sure, I may fade the low edge, perhaps little failures to outside that area. I may take this exact trade again if we break out of there, pull back, and start to go there. It just repeats these same trade principles over and over and over. If time and or volume builds at the edge of a balance or range, price is likely to actually push through. So this would be in terms of a price action pattern, a descending wedge, okay? But the key is that it's right into the edge of a balance area, which one of our laws or market dynamic kind of rules might tell us, oh, well, I should only expect rotational behavior within the balance area. Except when you see this type of a strong pattern, tries to bounce, comes back to the level. Tries to bounce even weaker. Buyers are not as strong as they were on the first push-up. Comes back to the level. Tries to buy again, it's pathetic, right back into the level, holding. We see that drop. It happens all the time. So, this acceptance concept, Yeah, Boris.
I remember one more rule.
One more to add? Okay.
Yeah, if you open outside balance area, very near to it, it's probably that we're going to retest the edge of the balance.
Absolutely. If we open outside the edge of a balance area, very often it will retest that. In my mind, it's the overnight session was the breakout, so it's a gap now, and that is the pullback to retest that area. It's any of our examples like this right here. Overnight we pushed out, now we're opening right here as the session starts, we retest and go. Absolutely.
Sure, you were saying earlier how if something doesn't happen, I'm just telling you something. So if that doesn't happen and price starts to go, say gaps up out of it, and then it doesn't retest, it just starts to go higher in the morning.
It's
increased volume. Is that probably telling you that
we're more likely for a trend day and things are very strong? Absolutely. That's one thing. I mentioned back in the slides that I didn't really care for day types and all this kind of stuff that most market profile people talk about. The one thing I will look at is the opening print for the day. Okay, here's where the opening print was. Very often, if you see us just above and below that opening print after the open, things are pretty quiet. It's not really, it doesn't have anything to it. It's rotational around where we opened. But if you open, and sometimes you'll see this, it comes back to the tick and retests that opening print and goes very strongly with increased volume and whatnot. That's a very strong sign of potential imbalance and future price expansion. And sometimes, I think what precisely you said, it opens and it just goes and goes and goes and goes.